to a certain extent, I want to try to work with public market investors to get the long term back right now.
What does that mean?
So I've been in the business for 30 years, and there's been this profound shift from shareholder passivity to shareholder primacy. And we've gone from one end of the continuum to the other, to an extreme. And whenever we hit extremes, we need a rebalance, I think. And so the idea that the extreme is this accepted principle that the corporate governance serves only one purpose, which is to maximize shareholder value. I think that, and specifically, that means that the role of corporate governance is not in the interest of the overall firm or in the interest of assisting it in achieving a corporate purpose. So you get this weird dynamic where profit follows purpose, or the idea that purpose, profit leads.
Right.
And
purpose is secondary.
And that, to me, that is that's just ass backwards, right? So in this way, I think capital markets and public companies are showing their limitations in terms of how they can play a role in societal good.
So how do you fix that? Is that your focus on sustainability and the new?
It is. I've been on more than 15 public company boards, and I've been in the problem. I've actually been on boards where we think less of other constituencies and more of the shareholder than we should. So I've tried to evolve and learn from my lessons. And I think our role today as long-term shareholder directors at ValueAct makes us responsible investors. I think poorly of these media-driven activist campaigns that hijack boards and make demands, short-term demands to sell your company or what have you. So we need to
boost return of cash.
Recap your company, split it up. So I think we need to get the long-term back.
Is that why ValueAct has been so innovative with arrangements like what we saw recently with Citigroup?
Well, that's just part of what we do, which is, we really do have an interest in making the companies better than where we left them, and that doesn't mean we have some sort of prescription for the company. There's a lot we don't know when we're outside the company doing research. So our goal is to get really smart, see kind of all the constituencies at this point, weigh them, and figure out, what will further the purpose of the company, and therefore drive long-term value. And with Citi, we have this problem because we're on a conflicting board, which we are in the middle of working through. But we just want to get smart so we can be, important contributors to a fact-based, unemotional decision-making process if we do go on the board.
And I know your successor is handling the Citi investment and the day-to-day in ValueAct, but I do remember seeing you talk about how cheap financials were this time last year. They must be really cheap now.
Yeah, it seems like at the end of the year, because the yield curve would invert 1 basis point, we're talking to computers, and the active investors kind of ran out of money, and they just, there was some sort of sell financials at any price. So now you have a situation where you've got companies that are almost utilitarian in nature because there's so much regulation and they're so de-risked that actually they're low-risk entities, and they're pretty fortified against a lot of macro risk.
It wasn't foreshadowing any sort of global recession or crisis.
It was a very non-fundamental price. And now you've got this idea that they're really overcapitalized with low-risk business models trading at 6 times. So there's tremendous value to create just by, reinvesting in yourself at 6 times earnings.
For the banks.
Yeah.
It's funny, hearing you talk about it reminds me of investing in utilities, which you've also been doing a little bit in this new sustainable spring fund. AES has been actually a monster, up I think 50% or so in the last year.
Yeah, I mean, it's that's been fun. We've moved to this kind of purpose-driven business. Up till now it was kind of this idea of having a I think the vision of the company was safe, reliable, and affordable energy. And in roughly March of this year, we changed our kind of our mission to impacting lives through accelerating greener, clean energy.
I mean, you've totally shifted the focus.
A clean energy future, right?
Yeah.
So there's lives, there's accelerate, and there's future. And with the Spring Fund, it is kind of be in the problem, have your core competency collide with a social or environmental need.
Coal.
Coal, exactly. Decarbonize, and then go faster, invest more, go faster, be a leader, and solve the problem. So tell stories within industries where you're moving faster to address to address the constraints. If you think about what's changed in the last 30 years, back to where we started, it could be that we have abundant finance capital. In the 70s and 80s, it was not so clear. The industrial age was capital and material constrained to a certain extent. Now we have this what I would call constraints in the social, human, and environmental capital front. And to a certain extent, I really think boards and CEOs want to take back control to allocate to and prioritize those capitals that are scarce. And so that is, I think, that is where the battle of the wills between companies and the investor class will play out. And I think it is a battle of the will. I think the investor class doesn't want to give up its primacy.
So, I mean, in companies, back to AES and some of your recent investments in the Spring Fund, are they more vulnerable or more safe in times of market turbulence and volatility like we experienced at the end of last year?
What is that more? What is more vulnerable? The companies?
Yeah, the companies. Do they get swept in, or are they sort of?
Well, I mean, I think if you're proactively, because you're in the problem and you're part of the fix, if you're proactively addressing environmental and social needs, in the long term, you're making your product or service more affordable and more accessible. And we're invested in for-profit education and the Spring Fund. We're invested in oil burning utilities. We're invested in petroleum-based fiber manufacturers. These are all businesses that are in the problem, but they have the technology to be part of the solution. And this technology is cheaper than existing technology with time and with investment. And so the ultimate goal is to make your business totally sustainable, because you're fixing this social or environmental problem while you're making your product and service of purpose to the customer. And then our goal is to prove out through stories that there is a sustainability premium to those sort of companies. And then it changes industries. Corporate behavior is the hardest thing to change, mostly because the investors don't want the money to leave the corpus. For some reason, they want the money now. They want it returned. They don't want it going into.
I wonder if PG&E was a cautionary tale on that front.
Yeah, PG&E is the first company to go bankrupt from climate change, it turns out.
And they did not change their model.
That's a complicated situation. I mean, they were made the insurance company of last resort by the laws of the state and the regulation. So they were almost vexed.
In general, what are your thoughts on the current market environment? Everyone here is talking about the global growth slowdown, the fact that U.S. growth may have peaked last year. How does that set us up for 2019?
I just don't think that way. You know, this whole idea that we're late cycle, I mean, I think it just plays to the idea that, you know, the markets are more of a video game than they are, you know, there's not a company behind most stock prices, it seems, in terms of who's trading stocks. So
does that mean active management is dead?
They're trying to kill it for sure. It is feels like last man standing to a certain extent. And so you get these macro proclamations. We're late cycle, and so people trade ETFs according to a macro thesis that we're late cycle, there's some sort of macro information news flow that causes one computer to try to beat the other computer to the punch. I'm not complaining. At some point, ultimately, there's a company behind the stock price, and if we can drive long-term earnings and make the company more sustainable, we'll do fine. It's just I'm worried some guys aren't getting to the other side, so to speak.
I mean, yeah, the hedge fund industry went through another storm in 2018.
Right.
What happens to your industry?
Well, it's like if you're the last share left, whoever's trying to buy it is going to pay you a lot for that last share. So if I'm like the last active bid left, I should do okay. We kind of anticipated this. We went with real long-term money. So Spring Fund and the main fund have 5-year lockups, and so we kind of feel like we can take the risk other investors can't because we have the time. That was good for the limited partners too, because we don't get paid until the end of the term. So we've always thought sustainably. We can't make money every year like some hedge funds do. We actually have to create sustained value because we don't get paid until the end. So I've always liked that alignment of interests.
Finally, part of the sustainability fund, and a lot of these companies need government regulation and to be partners with government. We're in a record long government shutdown in the U.S. Is our government a headwind or a tailwind?
Government is so important and so part of the solution. In the trust in government and the trust in companies is gone, which is why you see the millennials looking for companies to reassert corporate trust. They look to companies to fix the problem, but they also don't trust the problem. So this is where the sustainability movement is coming from. But the idea that companies have to be more involved in policy only because the good actors are going to be dragged down by the bad actors if they don't get involved in government policy, So I think it's in the company's interest to be very proactive on policy, and policy will move things faster. We just don't have that much time. I mean, if you read the IPCC, we have 11 years, we can't be renewable by 2045. That just doesn't get us there. We need to be renewable by 2030,
Mm-hmm. But I guess what I'm asking is, this is not, the priorities that you're saying are not what we're hearing from the current administration.
No, it's a problem. Maybe there'll be a backlash to the ineptitude, and we'll have government come in and be constructive again. Companies therefore have to do it themselves, and fill the void. To a certain extent, you're seeing that. The CEOs didn't show up for the Paris Accord during the Obama administration, but they did this time. They get it. They get these constraints we talked about earlier. It's just government would be such a good partner if we could get that to kick in.
Is there anyone you want to see run next year?
No, I'm not very political.
But you care about these
issues. I care about society. I'm just not going to puff my chest and pick winners.
All right. Jeff Ubben, thank you very much. It was a good conversation.